Welcome to the Risk Reversal Podcast. I am Dan Nathan. That is Marko Kolanovic. Marko is the former Chief Market Strategist at JP Morgan, friend of the pod, friend of mine, friend of CNBC's Fast Money. Marko, welcome back to the podcast.
Thank you.
You and I first met, it was 2015 on the set of Fast Money. Man, that goes quickly, doesn't it? Right? Yeah. And at the time, I remember you were introed as the man who moves markets. And we're going to talk a little bit about just how you think about making a big market call. I remember thinking about it. You were not one of those guys. You were definitely very tactical, and you used a lot of different inputs, and there was a lot of derivative kind of stuff in there too. So we're going to talk a little bit about your process since JP Morgan. You are a prolific tweeter. You can find him at Marko, MarkoInny. That is Marko. He is in New York right here. We're going to talk about basically what the Fed said. There's a lot of, we only had one dissent. We know who that was at the last meeting. We got the first quarter point cut since last September. We're going to give a sense, or you'll give us a sense of what you think the rate cutting cycle might look like. There was some really interesting economic data today. We also have the S&P, which is down about 2% in the last couple days or last few days. And we're going to talk about some seasonality. Where do you want to start? You want to talk with like a little bit the last week, a lot of Fed speak? Yeah, let's go there.
Yeah. Fed was last week, but really there was a Jackson Hole before end of August, where sort of market started assuming a series of rate cuts. Then basically market started rallying in September, and I thought most of it was priced in. Certainly was priced in rates. It was priced in FX. Even if you look at the crypto didn't rally after that. If anything, started selling off. But equities were, still excited, partially because of the rate. Other things, clearly AI and all these deals.
We're going to get to AI. I'm going to tell you that.
But market sort of creeped out, and then you had the Fed on Wednesday. Reaction was kind of a little bit odd, right? You had first a little bit of a drop, then rally, and then drop flat. But the next day you had the follow through. And again, there was some sort of AI news, but market rallied in relief. Now really sort of, if you look at what people are saying, and there was this one particular piece of analysis where people were saying, once when the Fed cuts and markets at all-time high, 100% of times market goes up next 12 months. And I thought it was sort of dishonest type analysis, right? For a few reasons. First, Fed already cut last year, right? So what are we talking, 12 months from now, or now is that 12 months that that's happening? Then, and simply factually, you need to sort of data mine a lot to eliminate, let's say, points like 2007 cut, because we know in 2007 Fed cut and then market collapsed in 2008, 2009.
And then your point there is that in 2007 we were at an all-time high.
Correct. Yeah. We're some will say you can a little bit data mine to exclude that point, but it's a little bit dishonest to exclude. And then you had the cuts around the COVID, right? I mean, market rally had nothing to do sort of with the rate cut. It had to do with the massive balance sheet expansion and stimulus, fiscal, monetary across the world, right? So there was this cheering sort of Fed cuts at the market highs, and that's got to be bullish, and I think it's far, far from clear. As I said, first, it's not clear in other assets at all, bonds, FX, cryptos. Second, historical, it's not clear. If anything, Fed cuts for a reason. Fed cuts because there is issues in economy. There is increased risk of recession. We had this whole confusion around the jobs, this 911,000 revision, and job market is softening, right? And the rates are still restrictive, and it's far from clear that this is a series of cuts back to back, right? So that was sort of Friday, and even Monday a little bit of excitement, but I think then reality started setting in. Look at the other asset classes, look at the data that got released even today, what we had. And then Powell himself clarified it pretty clearly, right? He said equities are, a little bit highly valued. Every meeting is live. We don't know. We're going to be data dependent, So I think market ran ahead of itself, and you asked me about like my process and what we talked like at the CNBC years back. This week was really set up a bit for a failure post Powell rally, right? You had a rally on sort of Thursday, Friday, and then Monday even market went up. But this week was sort of worst week of the year for a number of reasons, and number one is, when you had the quarterly expiry, like, this triple witching, and when the market sort of rallies into the expiry, what happens in the market, options need to be rolled, and basically in the S&P market, the S&P indices or broad indices, typically structures that are in place are collars, like a zero-cost collar, put spread collar, those type of things.
Risk reversals, people. That's the name of the podcast. There you go.
Yeah.
Yes.
And you have overwrites, so you blew through all these call strikes, and when you roll these call strikes, you need to be buying stocks into the expiry. So you kind of overshoot. So last week was a little bit overshoot, and then kind of you have a reversion of that, risk reversal. Not reversal. You have a bit of a reversal because market kind of you have a lot of temporary buying demand. It's something I wrote about many years back. But this week you had that. Then you had the seasonality sort of sell Rosh Hashanah, buy Yom Kippur, right? Like typically it's a week that is seasonally I think 80% of the times actually weak. You have a month end. Next week, right? And you will have pension selling, right? Because if you look at the Nasdaq rallied, up until Tuesday, rallied like 8% for a month. So suddenly, if you have this allocation, you need to trim it down. If you're targeting some fixed weights, right? So you have that month end,
and that's the pension selling.
Yeah, correct. That's gonna, and that's not started yet. That's gonna probably be next. So sort of Friday, Monday, Tuesday.
Is there some sort of unwritten rule how they do that? How they do their own rebalancing?
Yeah, there is. So basically, and I studied this a lot before. Monthly. More frequent rebalance is monthly than quarterly, but we have now double, both monthly and quarterly. But monthly is a lot more important than quarterly, right? So basically, if the market rallies, if you look at it statistically, when the market rallies going into the month end, these last, let's say 3 days, you have about 10 to 20% of that rally is given back. Just when you do the regression, you find that, sort of if you talk to many of these funds, they'll tell you they do that. They're smart about it, so they're not putting it on autopilot. They look tactically, if there's a lot of front running, they may wait. So it was in the news. Some of these pension funds were asking their boards to give them leeway to do it, up until like 1 or 2 days after month end. So they're not like really blind, but net. Month end is still sort of where people report their performance, report their weights, and those type of things, and you have that, so that's a weakness.
And so going back though, the last 2 months, so we had like a 2% sell off ish at the end of August, and then the end of July we had about a 2% sell off too. And we'll get to the AI stuff because it's really interesting. When you were talking when we started out just a few minutes ago, you said the macro and as it relates to monetary policy, but then you also said AI news, and that seems to be a huge driver of a lot of the market action, the concentration, the GDP, I guess contribution and the like. So we'll get to that. So the last two real sell-offs we had since, this is crazy, since late June when we broke out above the prior February highs came at month end again after July and after August.
Yeah, that and it's not a coincidence. It's not the only driver, but is a contributor, right? Because market was rallying pretty much since April lows, right? So every month your equity weight was going up and up and up. So you sort of end of the month, investors, they target fixed weights like 60-40, they kind of trim it. So it's not a coincidence, I think, that you had both of these pullbacks. But market was going sort of extraordinarily smoothly, and especially this September. I was a little bit surprised. You had, I believe, 14 or 15 back-to-back sort of up days, like in Nasdaq. Down day was like a minuscule, it was like a basis points. But so you had this extremely sort of smooth run. So that's why I think sort of this week's bound. You had the market was overbought as well. RSIs were all in overbought territory, and then buyback blackout. We're kind of getting 30 days to earnings, and then there's a less buyback activity also. So that's why this week is going to be a little bit of a test. I think whether this week and also into Tuesday next week, whether this can spiral into something bigger, which you mentioned, sort of all these derivative, the technical, systematic aspects. At some point, if you trigger certain levels, whether it's volatility going up or momentum signals being triggered, you could produce something bigger. But that sort of remains to be seen. I guess by Tuesday we'll know.
Let me ask you this to take a step back on the buyback thing, because we heard about a lot of buybacks in April and in May, right? And we actually heard plenty of executives of Fortune, or S&P 500 companies doing that. You don't hear a lot of that right now. Now, there are two companies that I think are really interesting to track. Earlier in the week, there was a headline that Stripe, so this is a company that's private. It's a very mature fintech company. I think there's very few in the private markets that are profitable. I believe that Stripe is. There's lots of bankers all over the street who would love this $100 billion market cap company, or at least that's how it's valued in the private markets, to go public. But this company, they just did a tender for employees and investors who want to sell. They're buying it back. So, which is, I think, really interesting. It says something to me a little bit about how companies are thinking about the IPO landscape and being public in general. And then I'm pretty sure Elon Musk, XAI just did, or X, or whatever they call the combination, they did a capital raise and he bought on it. And you know what's interesting about that? I think the first 10 raises that Tesla did, Elon bought. He was on the buy side of each one of those, which is pretty fascinating. And so I just wanted to highlight those two things because your old boss, Jamie Dimon, over the last couple of years has mentioned on a few occasions, I wouldn't buy my stock here because it's trading at 3 times tangible book, that sort of thing. So I just wanted to get the buyback thing. And if you tell me that we're in a buyback blackout into earnings, this is something, I guess to your point, that if there was a reason aside from month end or quarter end selling where things could kind of get going in the next couple of weeks.
That's correct, right? And look, at some of these buybacks you have like on autopilot, they usually get triggered when there's a big sell-off, but we are trading still close to high. I mean, sort of within 2% of a high, so those I don't think are very active. And then these discretionary ones where the management decides, those are getting in a quiet period just because of the proximity of earnings. So that's a little bit of a less demand as well. So you have like these 4 or 5 confluences this week going into the October 1st that are putting markets at the risk. And that's what we're seeing sort of basically Tuesday, Wednesday, Thursday, 3 days for the first time. Now there is this technical, 3 black crows, and you always learn something new. Early in the year, it was Zweig Bread Trust, that was a big thing. Now you have these 3 black crows, which is basically when you have all-time highs and then you have like a 3 successive days with sort of lower lows, lower highs. Some people read into it that it could actually be inflection point. So maybe, not just the month end, but actually start off a bigger correction.
All right, let's go back to rate cuts and the expectations here. So, the Fed chair, Powell, called it a risk management cut, which I think a lot of folks, if you're not on, a certain side of the fence here, you know what I mean? They thought that comment, so it was a hawkish cut, if you will, right? And they basically, the dot suggested that there was going to be 2 more 25 basis point cuts this year, right?
Yeah,
sort-ish, right? And that's changed a little bit in the last few days, and we'll get to that. And then 1 next year. Okay, so when you think about that, you just mentioned on the day of the cut, the stock market sold off a little bit, maybe 40 bips or something like that. The next day, though, right out of the gate, off to the races. All right, so then here we are, flash forward a week later, we have data this morning where GDP is better than expected. So the average between Q1 and Q2 with the revision is 1.65. It's interesting. Fed Chair Powell said expectations for GDP first half were 1.5%. He did say they're likely to be a little better. Now, growth is not part of their mandate, right? So it's stable prices, and it seems like that inflation, while it's not going down too much, it's not going up too much, so it seems stable-ish, but above their target, right? And then if you think full employment, that's the one that's been the big wrinkle over the last couple months, right? Going back to the July report and the revisions and that sort of thing. So how do you see this thing shaking out a little bit? Because today we have better than expected GDP. There was PCE. There was a couple of, there was nothing. It basically suggested that, the economy's okay. Can we take that away from today's data? So that pushes down rate cut odds just a little bit for October, and the stock market as we speak, it's about an hour and a half into the close on Thursday, and the S&P is down 65 basis points, not that much.
Yeah. So recalibration, right, like of I think these dovish expectations post-Fed, Thursday, Friday primarily, Thursday, Friday, Monday, now we had a Powell's comment, we had a data points today, we'll have some important data points tomorrow. I think there is a lot of uncertainty, and I think Powell was, fair saying that we will look the data as they come in, right? Uncertainty around, if you look at these employment numbers, these revision, I mean, I'm not an economist. I look at it closely, but I don't have a good feel really like sort of how seriously you should take these revisions, right, of payrolls, right? Then you look at there's definitely uptick sort of companies announcing some cuts, or some concerns. There's this sentiment about graduates having really hard time finding jobs, Then, even when you look at the sort of other moving parts of economy, a lot of conflicting data, like for instance, trucking, this cost index falling off the cliff, but then some other indices showing actually economy is doing pretty fine. So I do think genuinely there is uncertainty for the path of economy, and there is going to be plenty of data to decide, whether this is going to be, 1, 2, or 3 cuts. I mean, in the coming meetings, and I think market will react a bit. But I don't think it's actually crucial for the market performance. And maybe it's a little bit of a contrarian view here. But if you look, this whole market rally last year and this year post-lows was really unrelated to rates, right? It was a tech story. It was AI story. And I was a little bit initially, skeptical. Especially once when market reached 6,000, I got actually pretty skeptical. I said, okay, look, this pretty sharp bounce, but for us to make new substantial highs, you do need to have monetary policy which is not restrictive. This is still restrictive policy, right? During the COVID, you had to flip the switch completely, like pedal to the metal, right? QE, fiscal, monetary, zero, negative interest rates. So it's not surprising that you have like rapidly to new highs. Monetary policy was restrictive. Nonetheless, equity is actually acting pretty well, right? And rationale was like, look, AI doesn't, it's really not about interest rates. It's about new technologies, new demand, capex. We're not, Russell got, some of these rate sensitive stocks, were struggling, but the whole market was driven by stocks which are not rate sensitive, right? So people were saying, we don't care about rates, we only care about AI, right? Like, so now you want to flip that. Why would now cutting from more restrictive to less restrictive, right? So it's not 0 rates or 100 basis points rates, still high rates. Why would it suddenly be the most important driver of the AI-driven rally, right? Because if you want to attribute between tech and consumer discretion, it's most of the gains are coming from there, right? So I think people are making a little bit of a question of fate of equities based on this, whether it's 1+ or 1- cut this year. I don't think it's that important. I think if you have a momentum shifting in this AI space or sentiment shifting, I think market can sell off even if the rates are cut substantially, right? And conversely, even if the rates are not cut, if the bubble continues, rates are not going to pop it. I mean, 1 or 2 cut difference is not going to make a difference because we're not lifting it from 0, right? We are in sort of 4 range, high 3s or low 4s, restrictive either way. So I think people are like putting a little bit too much importance, I think, now, right? Because conversely, if the rates are to be cut very rapidly, that means the economy is going to be falling off of the cliff, right? And then I think equity go down.
Well, all right, let's talk about that for a second. I just want to make one correction that I said. So Thursday morning, it was personal consumption, not PCE. Tomorrow morning, Friday, by the time you're listening to this, will be PCE. And then if you flash forward, there's a bunch of data next week and really capped on October 30th, next Friday, with the September jobs report. So it will be interesting to see how the bond market responds to that. We have a 10-year yield that's kind of crept up since that rate cut. It was sitting that day at 4%. I think it went through it briefly, maybe 3.99, and here we are today. It's basically 4.18.
Yeah, right? 18 bits high, right? Like, so even my first reaction was like, why are you cheering? Basically, across the curve, everything is up. 2-year, 5-year, 10-year, 30-year, right? Like, this is not like dovish.
Yeah.
Like,
all right, so let's break something else down that you just said. So you said that if we were going to have more rate cuts than expected, that would mean that, we'd see a disastrous September print as it relates to jobs, and we'd see, all right, so how do you how do you square this circle? If we actually see inflation sticky, which I think you expect it to continue to be to some degree, and it doesn't mean it has to be, and then you see a dramatic weakening in the labor market, which it has been dramatic actually over the last 3 to 6 months or so, does that ties the Fed's hands here a little bit? You know what I mean? So the idea that they could just cut because the labor market's weakening, which is what they did September of 2024, the inflation, they expected inflation to be much lower a year later than it is right now.
Yeah, well, I mean, we have these tariffs, right? Pretty substantial that, people say one-off, transitory, but, nothing is one-off or transitory entirely, right? There's always a knock-on effect. There's always some time where things propagate through system and, one thing causes the other, right? So I would be cautious to sort of dismiss the tariffs, right? So you have that, right? And so that's compared to 24. But even if you want to compare, 10 years back, I mean, when we had the sort of problem of deflation structurally, it was very easy to quickly just cut support, and, people are sort of saying, well, Yellen or Bernanke, like they were like every 5% drop in the market, they would sort of just cut, they would, talk about cutting rates, they could do it because there was no inflation. Now there is inflation, and I don't see it sort of going away short of demand shock, right? Like so going into recession, then, it's going to collapse inflation as well, right? But earnings will do as well. Yeah, so I think the hands are a little bit tied, and then there's this elephant in the room, how the Fed is going to look like next year, right? I mean, this whole comedy with Lisa Cook with kind of, I mean, Trump sort of openly said he wants to have a majority of his people on the Fed, right? So that's another, so do you really want these rates to be cut? And then back end becomes like unanchored and causes all kind of problems in equity markets. And so that's a risk.
Well, let's talk about that for a second. All right. So the whole idea, let's just say from a political kind of, hatchet job, if you will, to get her out of there, then he is able to appoint another governor, right? He just has this guy, Steve Marin, just joined as a governor, replacing. So he will have a majority then, and then they could start coming at these regional Fed presidents, right? And so then he's going to be able to appoint a Fed chair. This comes, prior to May of 26, and I think in that scenario, they'll probably announce somebody relatively soon. So this whole idea of a shadow Fed president, do you think that is the sort of thing, or Fed chair, excuse me, do you think that is the sort of thing that could influence monetary policy? If he did have the majority on the governor front, and then they've already named somebody who's going to be Senate approved for the chair, will that have some impact on monetary policy?
I think it will, and I think there is going to be interesting to see market reaction, both domestically and internationally. And it's, I don't think we had that ever before, right? I mean, we saw these type of things in emerging markets. They don't typically, end up well for their risk assets. But who knows how it, U.S. is, still a reserve currency and the biggest, most liquid bond market, so I don't know. I don't want to say like it's going to spell a doom for U.S. Treasury market, but I could see on a balance being negative for the yields at the back end. And equities are long duration assets, so they should be priced not necessarily of Fed funds, but sort of more of the back end, as do mortgages as well. So I think there's probably going to be some hiccups along the way, right? If for instance, this guy was saying like 50-50-50, that's his dot, right? He wants to go, if you do that, I think equities would sell off because I think back end of the curve would rally.
And the equities sell off because the contribution of the massive, hyperscalers and basically the top 10 names, they are long duration assets. They're spending hundreds of billions of dollars to get some return in the future, and you're going to have to discount that some degree. And if you have 30-year yields going higher, that should put pressure on their valuations.
Yeah, and the mortgages, housing market, and sort of and other rate-sensitive stocks, and anyone who's borrowing, longer than certain Fed influence the front end, right? You would need to price in a higher borrowing cost for them as well. So it's kind of tricky. Kind of be careful what you wish for, and I don't think we know how it's going to play out exactly and what's going to be impact on the market. But I would say on a balance, it's probably something that's a little bit destabilizing market. If you remember back in I believe 2018, in the winter or fall when Trump first started saying about firing Powell or something, market went haywire, right? It was not, now it was a little bit sort of eased in. So we have this discussion of this guy, he's an idiot, too late, we're going to fire him. So it's kind of every single day. So market kind of tune it out, right? But that doesn't mean that I think market is comfortable with the Fed losing independence and basically doing what president tells them to do. And president wants, I think he has this view that sort of market needs to keep on making record highs, rates needs to go down, and that's going to somehow all work out, and there is some chance it works out, but there's a chance that you basically get a little bit of a tailspin, and so I think that's another, so whether it's going to be 3 cuts or 4 cuts or 2 cuts, we will get also to that issue of Fed independence and how the, the monetary policy looks like in the future, and, so that's a risk as well.
And you just mentioned this is like if the Fed has to cut more dramatically than is priced in right now because of a weakening economy, that's not exactly a great thing for equities, especially if you don't see the 10-year come down and you see the longer end come up. And we haven't even talked about this yet. I mean, a lot of that concern with the 30-year is kind of the debt, deficit spending and the like. We have, a few days from now, less than a week, we have the potential for a government shutdown, which is also at the end
of month.
So, and one of the interesting wrinkles, and I'm sitting there and I'm reading this morning, and I'm like, all right, this is if you're trying to negotiate, if you're the White House and you're Republicans and you're trying to get the stopgap, continuation for 90 days or 60 days, whatever the heck it is, I think it's into November, this headline was really interesting. So the OMB suggested that if we do have a shutdown, you will obviously have the normal furloughs of government workers, X the critical ones or whatever they call them. But then they're also going to ask every division to get, or every institution or whatever department in the government to basically come up with a list for reduction in force. So basically get rid of probably tens of thousands of workers. And I guess the political aspect of that is like, will that be blamed on the Democrats if they don't vote for the stopgap? And that's a really interesting scenario, because the last time they had the ability to basically shut the government down to try to negotiate for whether it's extension of healthcare cuts, that's what the deal is right now, they folded. Right. And they weren't. Now there could be some political repercussions for that. So give me a sense of how important you think, what would happen if there was a government shutdown? Because the Republicans might really dig in also now that they have this, this leverage.
So look, these shutdowns sort of always end up being more or less a non-events, but there is always some volatility around them. And in a few occasions, there was actually real economical cost. Now, this, as you said, this time things could be slightly different because it can be used actually to sort of eliminate a bunch of, like what Dodge back earlier was trying to do. This could be another way to sort of use that to some sort of political advantage or to further sort of political goals. So it could actually produce more real damage. So I wouldn't say that's going to be the only thing that's going to sort of crack the market, but sort of you're putting now increasing number of things on the market, and at the market that has valuations close to high. So that's sort of another thing that is going to be overhang over the market next 1 to 2 weeks. So again, I wouldn't base my thesis of a sell-off just on that, but when you look at all of those things on the negative side and ask yourself what's on the positive side, basically only positive thing you can say, okay, the tech multiple can re-rate higher, right? But even there, you see saturation, right? These deals, like we had sort of 2 weeks ago, last week actually, we had the sort of the NVIDIA, Intel, then sort of OpenAI, Oracle, right? Then sort of OpenAI, NVIDIA, really. So these things kind of, they pop the market, interestingly, you sometimes see the market overnight creeps and then in the morning you get a news, like which kind of, I get a little suspicious, but that was sort of a propping up market in September, right? Now, what's happened sort of yesterday, day before yesterday, more of these deals are announced yesterday again, sort of, open up, market doesn't react anymore, right?
Yeah.
Like, so I think you used up a lot of these bullets, these big numbers, 500 billion, 100 billion, trillion. So that was sort of plowing against, call it negatives, concerns about economy, geopolitics. When I was coming here, there was like a headline that Europeans are going to shut down Russian planes, or nobody cares anymore, right? Like, but you had sort of trade war, you had this economy in a weird sort of slowdown and increased risk of recession. You have so tariffs, that, geopolitics, a weakening labor, right? And AI is a counterweight to all of it, right? And that's starting to sort of, I think, market is starting to less positively react to these news. And now you have a few of these things coming. Some of them technical, some of them fundamental, like a government shutdown.
All right, let's talk just real quickly. So just to wrap up that market conversation, on a scale of 1 to 10, how bearish are you? Let's say near term. What would you say?
So near term, I'm a lot bearish. And I posted something. I said sell. I posted something on Monday or on Friday. I said sell is very, very likely. It was, and I don't think I wrote before very, very likely. I went on a limb, and that was these technical confluences into the month end. Maybe October 2nd. So short term, quite bearish, right? Depends how much market pulls back. If the market pulls back 5-6%, I think we need to reassess for the potential bounce back after that, closer going into the year end.
And at that point, would it be that investors A are thinking year end, B, you can look past just kind of at that point, it will probably be pretty solid that we're going to get another 50 basis points by year end cuts, right? And maybe you have a year end mark, and maybe you continue to see some of these names that are performed so well, the big ones, that they're going to be like a little bit of a blow off,
Yeah.
And that's the pain trade, right?
Yeah.
Like for some of those folks in big funds who kind of lighten up on those names, you might have to kind of rechase that sort of thing.
Them, yeah.
So yeah, I see that. So in the near term though, if we were to get a move back towards, let's say, the 200-day moving average, which seems very unlikely, that was like, let's say by the time we get there, it'd be like 6150, which is it's 60, 10, 15 right now, but 6150 was the February high. That almost seems like that would be a dream
buying
scenario.
Opportunity,
yeah, buying opportunity.
Unless there is like a clear signs of recession and stuff. Yeah. But as of now, I doubt we'll get down to 200-day moving average, but like 50 moving, which is higher, it could be, right? So your question, how bearish? I'm fairly bearish now short term. For the year end, I'm more like 50-50. There's going to be a number of data points for the central bank, for the tariffs as well, and for the real economy. Just one thing, these tariffs, people forgot about them, but they kind of started really in August only for real, right? So that also something one needs to monitor.
Yeah, it seems like that whole idea of a pull forward, that's one of the reasons why we saw a negative GDP print in Q1, and that was really into that March sort of thing. And then we got the give back with a 3.8% or something like that. Yeah. If you do the math, I think I said 1.65% on the average. All right, let's talk about this AI. Every morning I wake up and literally, other than some stuff that's coming out of the White House, which is definitely newsworthy every day, that seems to be their strategy a little bit. But then the first few stories about markets or, about anything is AI related. And I put together a little list. I do this every week just for shits and giggles here, okay? So this is just in the last week, and these are headlines from the FT, from Bloomberg, from CNBC, from the Wall Street Journal. You ready? I'm just going to rip through them. AI is not a bubble, but if it were, here's how it might pop. That's from the FT. It was an opinion piece. NVIDIA-backed Nscale raises $1.1 billion in investor frenzy over AI infrastructure. That's the FT. OpenAI is upping the ante massively, also the FT. Oracle looks to raise $15 billion from corporate bond sales. Some of those came at like 6.25% or something like that, okay? Oracle's AI-fueled cash crunch sets stage for major job cuts. That's pretty interesting, okay? But again, the AI-fueled part is what's interesting to me. NVIDIA's $100 billion bet on gigantic AI factories to power ChatGPT. You just mentioned the OpenAI investment. OpenAI unveils plans for seemingly limitless expansion of computing power. In OpenAI mega deal, NVIDIA discusses a new business model, chip leasing, okay? And then OpenAI expands Stargate AI project with 5 U.S. sites. Okay, that literally, I could go on with another 20, and that's just this week.
This week, yeah.
All right, so talk to me about the sentiment. Let's talk about the sentiment, and that's not just the media. That's the stuff that is moving markets.
Yeah.
That is the most important driver. Forget the macro. That's it.
Yeah. No, that seems the playbook. I think it started, started a little bit with that administration when they back, in February when they announced $500 billion with
the Stargate. That was Massa,
Stargate,
Larry
right?
Ellison,
and sort of they used that playbook since then. You had that like a White House dinner with Trump and all the tech CEOs, and basically they were going around the table and each person had to say a number, right? Like 500 billion, and then you had the hot mic with the Mark Zuckerberg.
It's amazing.
He said like 600 billion, and he said like, oh, sorry, I didn't know like what you want me to say, so I kind of say what I thought like you want to hear, but we'll kind of work on it, right? Like so that's the playbook, right? So they got a sort of green light, go out, throw out these numbers. We're not gonna hold you accountable, but I may kind of draw on that number when I need it, right? Or when we need it, right? Like let's say market is weak. Then go out and announce like an Nvidia that you're buying Intel shares, investing, or go, or OpenAI,
$100 billion. Take $10 billion right
Oracle,
now.
Oracle, right?
Yeah.
And then TikTok, those type of things, right? Like so, there's sort of almost like a bag of trick. These things that you first ask for some commitment, and then you can pull when needed, right? When needed, and I think it became a little bit sort of. Definitely over the top, right? So that Oracle thing, kind of when I saw it first, I was like, how is it possible? And then it's a memorandum of understanding, right? It's a sort of 5 years out. We'll probably do this. Maybe we'll do it, right?
Can I interrupt you for 1 second? Okay, so 5 years out, $300 billion in revenue, hopefully.
Yeah.
The market gave them that in market cap.
Right away.
All right. So explain that to our listener a little bit, because that's not something. Can we talk about discounting, that sort of thing?
It's crazy, right? It's crazy. It's irrational. It's not logical. Exactly. What are the risks? Okay. So look, we may in 5 years, like we're talking about whether we have a recession next 12 months, and probabilities are pretty high, let alone in 5 years, right? There's going to be somewhere stop to that, right? And things are not going to grow like exponentially like that. There can be a million things that can go wrong for that not to materialize. As a matter of fact, if you want to look at it rationally, it's probably 90% is not going to materialize, right? If you want to see what everything can go wrong, competition, recession, new technologies, new entrance to the market, cheaper,
or your inability to other markets, like access to other markets, China, for instance.
Correct, which we actually saw, right? I mean, China threw right back and says, like, you know what, we're not going to buy your chips, right? Like, period, right? We're not going to play this game anymore. So forget about your growth, right? In this neck of the woods. And matter of fact, we're going to have our own chips, which are going to be cheaper, and we're probably...
Do you think it's weird that there's been a massive discount? So go back to January, the last week of January, the DeepSeek, the data's published. I mean, even if you want to discount what they said they spent tens of millions of dollars versus tens of billions to trade that model. That day, NVIDIA sold off and closed on the lows down 17%. Okay, so think about what is being discounted right now, even if it's just 10 billion or 20 billion, you know what I mean? Like, that seems like something that people should be paying attention to. And then the other aspect is that, on again, off again, whether they can sell the H20s, this is NVIDIA, into China, the only way that they were going to be able to do it as of a month ago is that if they were paying a 15% vig to the government, and then the Chinese government says, wait, you told me that we're not even selling you our best, our second best, or our third best. And they're like, you know what? They say to their locals, and they have listen, we're trying to act like them, if you will, but they can have influence on their companies. And they said, don't buy them. Right? And so they're forcing them to innovate. Huawei is trying really hard. I'm sure there's some others, but there's risk to that strategy too.
For China or for us?
For us,
of course. I think it's over effectively. I mean, like, look, Chinese are going to lag behind, right? But in this day and age, you can replicate things. I mean, like, maybe not in a week or a month, but in a year or two, you can, right? So I see, and I wrote something like that. So we have this gold rush, right? Although this MIT study shows that 95% of these projects are unprofitable. They're a waste of money, right? But fine. Let's say there is a gold rush, right? And now overbuilding this capacity, right? NVIDIA is highly concentrated in a handful of customers. Two of the customers are majority of their business, right? That's, again, projecting this growth that will get to 100% stop if there is recession in the U.S. Everybody will... these CEOs are saying, hey, we're going to rather go bankrupt. No, you're not going to go bankrupt. I mean, we know what happened with the metaverse and Facebook.
CoreWeave might go bankrupt. But, but you know, and then Oracle, you know, like it's the first time since 1992 when free cash flow went negative, and it's going to stay that way until 2029 if they keep up with their
commitments.
Their commitments, that sort of thing.
Yeah. So I think it's extremely risky, right? Like, and then you have these overseas markets that basically now with the China, as you said, you know, first best, second best, third best, 15%. China said enough, not just stop buying, but even existing orders cancel them, right? And we're going to make our own stuff, right? And they're going to be pushing, when they make their own stuff, they're going to be pushing it on all of the BRICS countries around it.
Digital belt and road.
Right.
That's what's going to happen.
That's where they're going to put.
And they're going to just flood the zone.
So who's NVIDIA is going to sell their stuff, right? So that's why they need to go and they need to come up with these crazy, you know, 300 billion memorandums, right? You know, or trillion, right? So they, but I think it's almost desperate. Sounds desperate to me, right? Like, you know, like, so your logical growth is going to get crippled around the world. You know, your valuation is already pricing a lot where the stock price is, right? So you need to somehow come up with some to replace that growth or keep that growth, right? You know, like, so I wrote something like in a gold rush, right? Eventually mines are depleted or there's no gold, right? Like, and at that point, the picks and shovels store doesn't slow down the growth. The growth goes to zero. Nobody buys anymore, right? So I think it's a very tricky and risky that you have these biggest stocks, these generals of the market are really highly levered to this one theme that's going to may stop in recession, may stop with some new technologies, and the growth will slow down, right? You know?
All right, well, let's talk about NVIDIA, and then let's talk about this sort of ecosystem and that they are investing in and who's investing in who and who's buying from who, that sort of thing. Just really quickly on NVIDIA, you know, expectations have come up for fiscal 2027. So that's next year. Earnings estimates, I think we're like 33% year over year growth. Now they're about 41%. On sales growth for this is again for next year, it's about 35% or so. It trades at about 27.5 times earnings. Obviously that 15.5 times sales is a little egregious, but this is the most important part to me. And this is maybe one of the reasons why you would want to discount a little bit of that earnings growth is that, you know, they saw a big step down in gross margins from last year to this year. It's expected to be like 71.5 or something like that. They're expected to reaccelerate to 74.5% next year, right? So that is to me the thing why this stock could get re-rated if you have a scenario like you just mentioned, right? A bit of a slowdown. So let's take a step back here. $4.3 trillion market cap company. All right. So when Microsoft invested in OpenAI going back to 2022 with a big investment in early 2023, you know, Microsoft was a huge buyer of GPUs from NVIDIA. And to your point before, the other big buyers ended up being Google, Amazon, OpenAI, and then Meta, right? And they had this massive customer concentration. But then all of a sudden they realized, well, Google is developing their own TPUs. Then you have custom silicon from Broadcom, NVIDIA. You have competition that's going to come in China. Maybe AMD gets their act together. So NVIDIA invests in CoreWeave. What is CoreWeave? It's a neocloud company, essentially a data center that they build out on the hope that people will come and soak up that demand. Now, obviously, Microsoft and Google and all these guys have been talking about, capacity constraint, that sort of thing. I think that's leveled out over the last year. But now you have NVIDIA investing in hundreds of startup companies. So what can they do to buy their chips? I'm sure they're giving them allocations for all that, right? Yeah. And then you have NVIDIA invest in OpenAI, like you just mentioned. What are they going to do with that first $10 billion? They're going to buy, right, chips. Yeah. What do you do if you actually have these huge data center contracts? If you're Oracle, right? You need to buy hundreds of thousands of chips, right? So OpenAI does a deal. It's all very circular. At some point, it would not take much of a slowdown. This is what we're talking about for things to really say, holy shit, they're all dependent on each other, right? The companies that have the balance sheets to do it, they're going to pull back probably pretty quickly. It's exactly what they did in 2022, right? When they started cutting jobs and that sort of thing. But there's a whole host of companies that can't do that. It's Oracle, it's CoreWeave, it's some of these other neoclouds. A bunch of these startups are going to go out of business. Let's be honest. You know what I mean? So talk about two things. The concentration of the the customers for an NVIDIA, and then NVIDIA investing in all these companies so they will buy their product.
Yeah, no, so concentration is basically at the multiple levels, right? Like, so first, if you look at the S&P, is concentrated into Mag 7s, right? And now that's even getting, with NVIDIA reaching the weight both in NASDAQ and S&P, and now you're expanding the links between these companies, right? Because Oracle is getting to towards $1 trillion. Broadcom, a lot of these things that trade very much in sync for various reasons, right? So now you're intermingling these businesses, and you are introducing this concentration to the risk of a slowdown, right? Where companies will have to protect their earnings, right? And again, they're very outspoken that they're not. Like, I think it was a Google saying sort of, we're looking for a digital god, and we're not gonna stop until we're the first one to find it, or something like that, right? Like, so there's a lot of big talk, but reality is when economic activity slows down, and when it slows down, like advertising, it's a lot of advertising, a lot of online sales. What's their bread and butter business for these end users of the chips, right? Eventually is a consumer, right? So I think this whole thing can unravel pretty quickly, right? And before leadership from other companies can step up, other industries and sectors to support the index, you could have a pretty big drawdown, right? Like, so index got concentrated in AI, handful of stocks. With, I would say, some challenges. You mentioned a lot of them, right? Like, it's not anymore just NVIDIA. Other firms are developing their own chips. International growth challenge with China now. And then at some point, China also becomes like exporter, like BYD, right? Exporter of, not importer, but actually exporter, competing with NVIDIA globally, right? Plus this recession. So I think it's a huge concentration risk, and it doesn't. And I'm not even, you can even mention geopolitics. China can also stop all of those shippings from Taiwan and stuff like that. So I think, for me, it's unusual that that's the biggest company in the world, the biggest company in the U.S., and that it has such a multiple. Now, NVIDIA has slowed down. Performance have been stalling a little bit. So sort of this last leg, especially if you look at this September, is these sort of areas around AI that took off. Like, these like kind of mini nuclear power plants. You have this company that is claiming to do that, yet they don't have any license to do any of that thing, right? Or you have like, crypto mining. Like, you have a bunch of these little companies which are sort of tangentially around the AI theme, and they're sort of taking off and taking this. So NVIDIA, in fairness, kind of stalled out. Isn't
it amazing, though? You just mentioned crypto mining, and 5 years ago, one of the biggest knocks against crypto in general was the mining costs, right? The access to energy, and all these mining operations were set up near dams and all this sort of stuff. Think about what the market cap is of every crypto right now, and a big part of it are stable coins, obviously, other than Bitcoin, which is, I think, 2 trillion or something like that. Basically, NVIDIA's market cap is greater than the entire crypto ecosystem, and the power that is basically going to be needed over the next 5 to 10 years just to see these projects out is like 100x of crypto mining. And it's just interesting that all of this, the narrative has been dwarfed, and now we're talking about turning on nuclear reactors that have not been turned on in 40 years. All this nuclear, all these names have gone absolutely ballistic, and then throw in, and I don't mean to sound so negative, because I think you and I are both in agreement that AI in some way, shape, or form, 10 years from now, 20 years from now, okay? And the cycles are getting accelerated. So it's not like going to be what happened from 1994 when Netscape went public or whatever, and people became aware of it, to 2010, where we had this just kind of app economy and, all this sort of stuff that was built on the backs of it. Real AI use cases will develop. These are going to be $1 trillion TAMs, probably, but it's going to take a while to get to. The cycles are accelerating, so we will have that. That's going to happen. I guess the issue is, what will these companies, right? What will they have pulled forward in valuation-wise? What should the multiples be for these? And is that fair? Because the energy thing, I think, encapsulates all of the, I guess, exorbitant enthusiasm that exists right now.
Yeah, no, and technology may evolve. Like you mentioned, the DeepSeek, right? Like, and fine, maybe you don't take it literally what they advertise, right? But there are probably ways to reduce, redesign the architecture. How do you run these models to consume less energy, right? Perhaps this industry will evolve, so I wouldn't sort of linearly say, okay, we're going to need certain amount of like terawatts of, energy to run these things, and it's just going to scale, and, things may look very different in 3 years from now, right?
Yeah.
And there could be some new companies that bring this type of technology, and maybe NVIDIA chips become at some point obsolete or not needed in such a quantity or shape or form, right?
Well, once the internet is mined and these models are trained, and then it just becomes inference, like, is there going to be demand
maybe
for
less,
Blackwell or Rubin or that sort of thing? And, I get all that. I want to make one point. And I was making prior to the April sell-off. I was kind of reminding people that in the highs in 21 to the lows in 22, Tesla, NVIDIA, Netflix, and Meta all sold off from their highs 70%. In the lead up to that, no one thought that could ever happen. And you and I have to go back 20 some years to see when, well, I guess we go back to the financial crisis, but that's a bit different. When companies that just were ahead of their skis valuation wise and, that sort of thing could sell off 2/3, right? And so when you go to April, NVIDIA is a great example. It went from 150 to like
80 or
85 or something like intraday. Well, let's just call that 40%. Okay. Now, obviously, it's much higher. That 150 that we got back to, this was kind of in mid-June, turned into 180. Yeah. Okay.
Yeah.
So if we were to go down, if NVIDIA were to go down from 180, 40%, that would bring you, I'll do a little math here, about 110. Now, no one thinks that could happen. Just think about that.
Right. No one thinks that happened, and we just had that sort of 6 months ago, not even 6
Correct.
months ago, right? And what was the catalyst? The catalyst was Trump showing this panel of tariffs, which, by the way, we have those tariffs now pretty much, right? So in reality, it was an overreaction, and it was sell-off also that triggered a lot of CTAs, de-risking, forced de-risking, and in such an environment, liquidity we have now, these moves are not just possible, they're probably likely. When the next catalyst happen, right? But to your point, nobody thinks that can happen. Back in April, we had it, and again, nothing at that point really dramatic change in the world. We had the tariffs announced, the tariffs that we have pretty much now, right? They were for 3 months postponed and gradually phased in July and August, and we are roughly there, right? I could see catalysts. Recession definitely would be one, right? That could trigger this type of unraveling, some of it technical, some of it fundamental.
And a recession would come from just a material slowdown in the labor market that could have a whole host of things. It could be government, it could be AI induced, it could be just general malaise, it could be college graduates not being able to, it could be tariffs weighing on manufacturing and other things. And that would be the start. You think that would be the...
Some combination of the things that I think were bothering market in the first half of up until April. You basically have tariffs, right? The biggest tariffs since last time, Great Depression we had, right? Which are slow to sort of percolate, but I think now they're kicking. And again, I'm not saying that will cause a recession, but that's one factor. Second is during the Biden years, the GDP was also growing because of the immigration. So you just increase the number of people in the country, right? Demand, you just inflated up. Now it's going the opposite way, right? And that's also to be determined what kind of real effect that will have. And then the sort of the regular cycle dynamics, right? I mean, we had sort of interest rates that were jacked up very aggressively in 22, pretty much stay there, right? From 0 to 5 and now down to 4, give or take. That's still, there's still a restrictive policy going on, right? And then you have some of these purely cyclical factors of excitement about economy, positioning in the market in risk asset classes, and then a reversal of that, right? So my point is, if we I think we didn't have a recession because of this AI real spending economy, but also AI wealth effect, right? How much money you added into people 401ks, into what it's AI, crypto, people feel better about it. So let's say this drops like 20%, that would be sort of another contributing factor to recession. I think people will spend back, right? But even with that, I think there for me, quite a bit of puzzling data. So what I saw yesterday, for instance, Las Vegas, visits and hiring going down. There's like a cost tracking index going down, right? So it's not clear, and you can kind of maybe explain each of this, but I shouldn't look at it. But there are these pockets, I think, that are concerning, right? So clearly, we're not in recession, but it's, I think if the market is to pull back 10, 20%, it could actually a spiral. A consumer would pull back, and then maybe you suddenly start feeling the tariffs. You suddenly start feeling the these other negative factors, and rates are maybe not cut as quick, or maybe it's too late, right? Because Fed was always too late. I mean, you have to give him that. Most of the recessions were one way or another. Fed was late to cut, right? So,
well, listen, I wanted to spend a bunch of time on the AI stuff because we keep hearing more and more that the contribution to GDP of AI spend is equal to that now of the consumer, and we know that the consumer has basically been 2/3, right, of GDP. And I just think what's going on here, if you're new to this and you haven't seen cycles in the market that were driven by some secular themes, there's been obviously a lot of monetary in fiscal policy that's driven a lot of the market, that a lot of folks who just entered the market in the last 10 years. But when you see this sort of investment, you see this sort of euphoria, you see a scenario where people have very, very short memories and they can't remember, how this stuff could go. I just think it warrants a double look. It warrants to look and see what you own. And you just said this is in people's 401ks. That's great. Don't ever sell your 401k, all right? But understand that there's idiosyncratic risk in some of these names in particular. And it's been my view, and I used to say this in 2022. You know what? You want to get exposure to the markets, you want to get exposure to the next big themes, then trade, ETFs, dollar cost average, the QQQ. You do that over the last 5 years, you'd be very happy. Even when we had 2022, you'd be happy even in April, that sort of thing. You'd be happy buying right here in 3 years from now, right? We can agree on that, because the idea of protracted bear markets, they don't happen anymore. Yeah. You and I lived through one in 25 years ago, but that was it. Think about this. In the financial crisis, the only down year was 2008.
Yeah.
And you know what I mean? And then the next year was off to the races. COVID, we didn't even have a down year.
Yeah,
you know what I mean?
Few months, yeah.
So, all right, let's end with this, because so folks don't just say, all right, well, there's Dan and Marko and they're doing their thing. And, hey, listen, use it as a contrarian indicator. Have a ball, okay? No, but I mean that. I feel like we have our finger on the pulse. The timing is going to be the scenario. But if you're listening to this and you don't buy it, but you believe it sooner or later, this could happen in one way, shape, or form, at least you have a framework for it. Is that fair?
Yeah.
I learned this long ago. If you have a bull case, if you are going to buy something, you better know how it goes pear-shaped. So you're not sitting there scratching your head when it does. All right, what can we be constructive on here in the market?
No, so I posted a few of these things, like when you had the healthcare. The healthcare was sort of in the first percentile relative valuation, so kind of lowest ever. You had some of these concerns about Medicare, Trump policies. Some of these companies got decimated, and then United Healthcare most prominently, but a bunch of the smaller ones as well, right? Like so when you see something down like 70-80% or 60-70%, right? And we're all gonna have healthcare, and poor people will have some form of healthcare as well, right? And maybe not this government, maybe next government, or maybe there's gonna be some deal done. So when you see something like that, 60-70% this summer, I thought that's, and I still think it's actually
like in a UNH in particular.
Yeah, like exactly.
And UNH has had a heck of a run. It's up $100, 250 to 350.
Yeah. It went to 250, and so that's one thing that I think probably over time will re-rate to where it was before, right? Value stocks, there are a bunch of sort of value stocks that also they're called value because they're still earning decent amount of money, but multiple dropped a lot because of some negative forecast or negative developments, right? But you have a stocks like, let me just, Lululemon, right? Like decimated, right? You have some of these staples, like consumer staples, right? Like a frozen food, beverages decimated, right? And look, there is always some story, right? Okay, consumer is soft, they don't buy these like yoga pants, or we can say, tariffs are pushing the price of tin for the cans, so cans are expensive, or like, Constellation, right? Like, okay, the beer, there's less immigrants drinking beer. Like, so you look at these things and when I see something which is sort of decimated, because of the narrative we have right now, like my view is kind of, okay, this shall pass as well, right? So at some point, people will drink beer, or people will, get their Medicaid back in some shape or form, right? And those type of things, right? Like, so I think there are cheap pockets of market. Now it's frustrating, right? Because like, even technically, these things are negatively related to your ultra high momentum tech names, right? Like, so when you have, Oklo or something like that rallies, you see these names go down, right? Because people are kind of trade long short, winners, losers, right? So they short losers, they buy winners. So these names are getting beaten down. But if your time horizon is going to be like a little bit, whether it's political cycle or market cycle or momentum style factor investing cycle, I think these things will do pretty well, right? Like, so you need to be patient, maybe sit on them for a little while, but there are pockets of markets which got decimated, like, so that part I would be positive, for the tech stuff, and again, I may be wrong on that and possibly, but I wouldn't be buying it right now. I'd be waiting for at least that little bit of a pullback,
I love that. I mean, like, we sit there and Fast Money, and every headline about Lulu or Chipotle or Constellation or UNH. I mean, think of these stocks; they're down, 70% or something. And these are like big brand names, and it could be, trends change. There obviously UNH is a different story. Mis-execution, competition, all those sorts of things. But it's kind of hard pressed that if you kind of just hold your nose and you kind of buy, let's say those four, that three of them are going to be okay,
Yeah. So that's the point. Like, I mean, each of them, each individually, they could fail. I mean, value traps and sometimes do go out of business. But if you sort of diversify a little bit across industries, and across the names, on average, I think that portfolio will be fine. You might have, let's say you buy 10 of them, one may go bankrupt, two may not recover really, but the 7 may actually double, so when you kind of average it out, I think that's going to be better than S&P 500, right? And again, there are these forecasts. Some serious people are forecasting secularly slower returns on S&P going forward, right? So that would be something that I would, on the long side, look.
Yeah, and just as a little PSA, as they say, like Target's actually a great example of a company that really might go out. It might be the next JCPenney. And I mean that because you think about this stock post-COVID. I mean, in COVID, this stock was trading, I want to say like $300. It's trading at $87 right now. And all it has done is made a series of lower highs and lower lows. And every quarter, just seems to be a gap in the chart. So for whatever that's worth, that might be the 1 in 10 that goes under. Down.
Yeah. Look, of course. And it's a philosophically, again, my style was always like sort of anti-momentum. If something looks extremely crazy, a lot of people jump on it. It says, look, I don't care what it is. I'm going to ride it, and I'm going to get out, right? And that works. You need to be agile and it works more often than not, but sometimes kind of spectacularly doesn't work as well. The same thing, like on the value side, it's basically beaten down things that are cheap always for some reason. It's not without reason, right? But you are sort of trying to see what can be turned around over a longer period of time. So it's a more painful, a longer duration, but it's a style that also works over time.
All right. Yeah. Last question, I promise. Where do you hail from? What is your home country?
Croatia.
Okay, Croatia. Some countries in and around Croatia, they have something called state capitalism. Right? Okay. Yeah. All right. So just last thing. So as we're speaking right now, it's 3:10 on Thursday afternoon. Intel is trading up 10%. Intel, the government took a stake. Good for us. I mean, this is going into the treasury, okay? At like $20.50. It's trading at $34. So first it was our government. Then it was NVIDIA. Now it's Apple. Now Intel, the headline here is approach TSMC about investments or manufacturing partnerships, okay? So if this, let's just say this stock doubles. Let's say it's at $40 in a month or so, okay? All right. So what does this mean? Like, for the government, great. If the stock goes to 50, they'll probably sell it and say, hey, this is a government, this is an administration that would say, listen, we literally just, you should trust us. Yeah. We literally just made you $15 billion, whatever the number is, okay? For NVIDIA, it's a rounding error. You know what I mean? Like maybe Intel, they know that Intel's never going to compete with them. Maybe there's something to do, right? Taiwan Semi, I mean, this company has tried to build foundries. They're no competition. So for them to get in the good graces of the administration, throw a little cash in, like the list goes on and on. For Apple to do that, Apple has been spending the last 15 years getting away from Intel components, chips, and everything like that. What do you, when you think of this, like when you see all this stuff, why wouldn't the administration start doing this everywhere they can? Because if they come to you and say, you are strategically important, we want to take an investment in you, how do you say no to them?
Yeah, no, so look, that's a sort of this state capitalism. It generally doesn't work, And look, if you pull full might of United States administration to turn around one company, you'll do it, right? But that's not a job of a government, and you can't do that with every company, right? And there is going to be some winner, some loser, and there is also going to be backlash eventually when the administration loses focus or a new administration comes, right? So yeah, you can make it go up for sure, right? They can decide to government buy everything from Intel, right? They can do whatever they want, right? Like, so they can make the stock go up. Temporarily, but as a sort of philosophical approach, it's not, really what a capitalism should be about. And you mentioned sort of my neck of the wood, like before, when I was a kid, like, I lived in a communism, and we had this type of, that was a rule, right? That was not exception, that was rule. And we know all these companies went bankrupt, right? And none of them work, right? I mean, government, they can, if they want to make something work, they'll make it work for a while, but eventually it's going to go astray and it's going to be waste, right? And the whole idea, I mean, like separation of markets and the government and, church and the state and all these things, right? So I don't think this is particularly positive. Again, if you were owning Intel at that point in time, overnight, it was very positive for you, but long term, I think it actually, if I need to put a market-free capitalism multiple and a command economy or state, I put a higher multiple on the free markets, right? Not on a sort of overall, right? And I think
all these deals are dilutive. Let's be honest. And then if you think about, like, if you're a real talent in the technology industry, do you want to go to Intel? Like, what are the curbs going to be? Remember when the government took stakes in all the banks? You were at one of the banks. Well, you were at the bank that was the best bank. But they put curbs on compensation and everything like that. Do you think that Intel is going to be able to compete with NVIDIA or any of these other tech, Google or something like that?
And
for talent?
Government is, as you said, they're going to put a curbs. They're going to call favors. They're going to direct them based on non-market or non-optimal motivation, right? Like, so let's say, how this whole thing with Intel started, right? Like, first it says, the guy, the CEO is a kind of a Chinese spy, the way I read it, right? He said, he's too close to China. Like, so that's unacceptable, right? But hey, look, if you come here and if you we give 10%, you're going to be okay, right? Then go to others, say, hey, now you actually go and you buy so this I can have a bragging rights, right? Those type of things, right? Like, so it's a kind of a little silly, But
a lot of silliness going on here, and of all the silliness, I think in the broader landscape of things, this is probably the least silly. So because people are making money on this thing, right? So listen, Marko, I could do this all day long. Hopefully, we'll do it more frequently than what we've been doing once a quarter. We almost turned this into a Joe Rogan-esque, length of a podcast here. But I really appreciate you being here.
Thank you so much.
Thanks, man.